Welcome to Griffonomics.
Thanks for having me.
So imagine discovering that the massive, completely mundane waste piles sitting outside a Florida fertilizer plant hold the exact critical minerals needed to power the next generation of American electric vehicles.
Yeah. And military defense systems, too.
Right. Suddenly, you aren't just looking at an agricultural supplier anymore, you're looking at a cornerstone of national security. And today, we are doing a deep dive into a company at the center of that exact reality, which is the Mosaic Company.
It is honestly a fascinating diagnostic puzzle right now.
Totally.
Because if you look at the raw data, Mosaic sits at this profoundly contradictory crossroads. So our mission today is to give you, the listener, a highly granular strategic report on how this company is surviving a pretty brutal margin squeeze.
Yeah, and we are pulling from their 2025 annual financial reports, the recent earnings call transcripts, some really detailed Seeking Alpha analysis, and geopolitical news.
Right, because Mosaic isn't just a farming story anymore.
No, not at all.
It's actually a proxy for global trade, for inflation, and, like you mentioned, national security.
Right, because on one hand, you have this massive 25% surge in global fertilizer prices, which sounds like an absolute gold rush.
Oh, exactly. It sounds great on paper.
But on the other hand, they are fighting severe, crushing inflation on the raw materials they actually need to make the product. So, I mean, if you're an investor trying to map this out, your first instinct is probably deep confusion. The math just seems broken.
It does seem broken.
Mm-hmm.
Until you really look under the hood. To understand how a geopolitical conflict half a world away impacts their stock price, we first need to, understand the anatomy of the company itself.
Okay, let's unpack this, because the sheer scale is staggering. We are talking about a vertically integrated global leader here.
Massive scale.
Right. For 2025, Mosaic posted $12.05 billion in net sales.
Yeah, that's with a B.
And that revenue rests on three primary pillars. First, you have Mosaic Fertilizantes, which dominates the market down in Brazil. That generated $4.85 billion.
Yep.
Then you have their phosphate segment, which is primarily those massive mining operations in Florida and Louisiana, bringing in $4.58 billion.
Right.
And finally, the potash segment,
Yeah.
anchored up in Saskatchewan, generating $2.66 billion.
But, if you look closely at those numbers, there's a massive structural imbalance that basically dictates their entire corporate strategy.
Yes. When I was reviewing the 2025 breakdown, this totally wild discrepancy jumped right out at me.
Yeah, about potash margins.
Exactly. If you look at the top line, potash is easily the smallest of the three. It only brings in about 22% of the total revenue.
Right.
But it somehow drives 46% of Mosaic's total gross margin. It is completely disproportionate. It's like a quiet indie movie that somehow bankrolls an entire major Hollywood studio.
That is a perfect analogy.
Mhm.
And understanding the why behind that profitability is basically the key to understanding Mosaic's survival.
So why is it so profitable?
Because potash isn't just high margin by accident. It is protected by this massive, almost impenetrable competitive moat. The secret weapon there is their Canpotex joint venture.
Okay, wait. Explain how that mechanism actually works, because it's not just a standard partnership, right?
No, not at all. So Saskatchewan is completely landlocked.
Right.
You can mine all the potash in the world, but if you can't get it to a port efficiently, it's essentially worthless. So Canpotex is this massive logistics consortium that gives Mosaic dedicated, customized rail fleets.
Wow.
Yeah, and exclusive high-throughput deepwater port terminals.
Yeah.
You cannot simply replicate that infrastructure today.
It would cost billions.
Exactly. So while the potash itself is a standard global commodity, Mosaic's ability to move it from a mine in central Canada to a farm in Asia, cheaper and faster than almost anyone else, gives them incredible pricing power.
So that logistical superiority creates the margins that anchor the whole company.
Exactly, especially when their other segments take a hit.
So if potash provides this ironclad, high-margin moat right here in the Americas, why is Wall Street currently panicking over events in the Middle East?
Well, because of the logistics of the global trade network, you have to look at the ongoing war involving Iran.
Right, the shipping issues.
Yeah, the conflict has severely disrupted commercial shipping through the Strait of Hormuz.
Which is a massive choke point.
A huge one. Over 1/3 of all globally traded fertilizer physically passes through that single strait.
That is wild.
It is. And with commercial traffic largely halted, or at least severely restricted, it has created a massive supply shock globally.
Right.
And this is happening precisely as farmers in the northern hemisphere are, prepping for spring planting.
Hmm.
That supply vacuum is exactly why we've seen global fertilizer prices surge roughly 25%.
I mean, U.S. urea imports alone jumped 30% in price practically overnight.
If we connect this to the bigger picture, this is actually where Mosaic's specific geography should be their greatest weapon.
Right, what the analysts call the Western Hemisphere hedge.
Exactly. Think about their physical footprint. Saskatchewan, Florida, Louisiana, Brazil,
Yeah.
their production facilities, and their immediate rail-to-port shipping routes are completely shielded from the disruptions in the Middle East. They don't have to navigate the Strait of Hormuz to reach the U.S. Corn Belt.
Or Brazilian soybean farmers.
Right. Yet because commodities are priced on a global curve, they get to directly benefit from that 25% price surge.
Okay, but wait, if domestic prices in the US and Brazil are soaring because of a global shock, what stops foreign competitors from swooping in?
Dumping.
Yeah, like if I'm a state-sponsored producer in North Africa or Russia, and I have access to ridiculously cheap government-subsidized natural gas, why wouldn't I just dump millions of tons of cheap fertilizer into the Americas to steal all of Mosaic's market share?
Well, that is exactly what would happen in a completely unregulated open market.
Right.
But regardless of where you stand on international trade policy,
Yeah.
and just to be clear, we are taking absolutely no political sides here regarding U.S. trade policy or any foreign disputes.
Oh, of course. We're just reporting the trade dynamics straight from the source material to help you, the listener, understand the market mechanics.
Exactly. So purely from a market mechanics perspective, the U.S. Department of Commerce legally equalizes the playing field here with countervailing duties, or CVDs.
Right. These are the tariffs designed to offset the unfair advantage of foreign government subsidies.
Precisely. Mosaic successfully petitioned for these protections. The Commerce Department calculated subsidy rates ranging between 2.12% and 28.50%.
Wow, that's a wide range.
It is. This applies to the Moroccan producer, OCP, and the Russian producer, Fosagro.
So those tariffs act as a legal wall, preventing subsidized imports from undercutting Mosaic's pricing.
Yes. But it's worth noting, for anyone tracking the regulatory calendar, these duties face a crucial sunset review in April 2026.
Okay, so let's tally this up. You have 25% higher product prices. You have a massive geographical advantage shielding you from Middle East shipping chaos. And you have federal tariffs protecting your home turf from cheap Russian and Moroccan imports. On paper, Mosaic should be printing a historic amount of cash.
On paper, yes.
But the 2025 financial reports reveal a bloodbath. Here's where it gets really interesting.
Yeah, the great contradiction of their 2025 fiscal year.
Yeah.
The squeeze.
Right, because the very same geopolitical conflict driving up the price of the fertilizer Mosaic sells is also triggering massive crushing inflation for the chemical inputs they need to make it.
The sulfur and ammonia.
Exactly. It's like owning a bakery where the price of your cakes just doubled, which is great, but the cost of flour and sugar tripled and your kitchen is completely stuffed with unsold inventory.
That is exactly what happened. Sulfur and ammonia are heavily tied to global energy and refining markets, and the reality of their 2025 cash flow is grim.
How grim.
Well, despite $12 billion in top-line revenue, Mosaic's free cash flow was deeply negative. They posted a negative $535 million in free cash flow.
Wait, $500 million out the door. How does a vertically integrated giant bleed that much cash in a high-price environment?
Because of a staggering $960 million black hole tied up in working capital.
Oh, wow.
Yeah. Because sulfur prices skyrocketed, it cost Mosaic significantly more cash up front just to manufacture their inventory.
Okay, that makes sense.
But then late in the fourth quarter, market demand suddenly softened. U.S. farmers experienced some adverse weather, looked at the incredibly high retail prices of fertilizer, and essentially went on a buyer's strike.
So they just delayed their purchases.
Exactly. So Mosaic was left holding massive amounts of incredibly expensive, fully produced inventory just sitting in warehouses.
Just doing nothing but tying up their operating cash. And Wall Street did not forgive them for that run.
Not at all. Bank of America downgraded Mosaic to a neutral rating and slashed their price target to $30 a share.
Yikes.
And their reasoning was entirely focused on that input inflation. The analysts warned that because sulfur costs remain elevated, Mosaic is staring down a massive $250 million EBITDA headwind.
In just one quarter.
Yep, in the first quarter of 2026 alone.
For anyone who glazes over at financial acronyms, EBITDA is basically their core operating profit. So you're saying just the inflated cost of raw materials is going to eat $250 million of their core operating profit in 3 months.
Yes. Bank of America stated that any meaningful margin expansion is basically delayed until 2027. And complicating this cash crunch is the fact that Mosaic's capital expenditures cannot be easily cut.
Oh, right, the CapEx.
Yeah, they are projected to spend roughly $1.5 billion in CapEx for 2026.
But why is it that high? I mean, if you are bleeding cash from a margin squeeze, you halt all the big building projects, why spend $1.5 billion?
Because a massive portion of that isn't optional growth spending. It's mandatory environmental and waste disposal infrastructure.
Ah.
Specifically, they are required to build and expand what are called gyp stacks, phosphogypsum stacks, primarily at their Florida phosphate facilities. It's a highly regulated environmental requirement.
So they literally cannot legally operate the mines without managing the waste.
Right, so that CapEx is locked in.
Okay, so let's look at the triage here. You have a severe cash crunch, exploding input costs, Wall Street downgrades, and $1.5 billion in mandatory environmental spending.
It's a tough spot.
Yeah, and you can't just borrow your way out of a structural margin squeeze. So how is management actually stopping the bleeding?
Well, they executed an immediate financial defense strategy first. To manage their liquidity and retire the short-term commercial paper they were relying on, Mosaic went directly to the debt markets.
And just to clarify for everyone, commercial paper is essentially short-term, unsecured corporate IOUs used to make payroll and keep the lights on, right? So they were essentially living on credit cards.
Yeah, very short-term debt that exposes you to immediate interest rate volatility. So in November 2025, they executed a $900 million public bond offering.
Okay.
And they secured that debt across 3-year and 5-year notes. They essentially traded the volatile credit card debt for a stable long-term mortgage.
Which buys them crucial breathing room. But restructuring debt doesn't fix a factory that loses money on every ton it produces.
Which leads to the operational defense, or what we can call the Brazil pivot. Management looked at the surging price of sulfur, ran the granular unit economics, and made a very disciplined choice.
What did they do?
They temporarily idled their lowest margin single superphosphate, or SSP, facilities in Brazil, specifically the Araça and Fospar plants.
Because SSP requires a massive amount of sulfur to produce, right?
Exactly. Rather than buying premium price sulfur just to keep the machines running and producing fertilizer at a net loss, they completely suspended local sulfur purchases and idled the plants.
Okay, so securing long-term bonds and shutting down unprofitable factories stops the bleeding. That's a solid defense. But if I'm looking at this as a potential investment, playing defense doesn't make the stock go up. Where is the offensive strategy for 2026?
The sources outline 2 very distinct offensive levers. The first is an aggressive AI integration strategy.
Wait, AI?
Yes. They are hunting for an additional $100 million in savings, specifically for 2026. They're deploying AI-enabled contract management and supply chain optimization designed to relentlessly audit and prevent vendor over-invoicing.
You know, every company right now claims they use AI, and it usually sounds like a corporate PR buzzword. But in global industrial logistics, this actually makes total sense.
Right.
Mosaic moves millions of tons of physical material across global rail lines, ocean freighters, trucking networks. The sheer volume of vendor invoices is chaotic. Millions are lost every year just to human billing errors.
Yep, duplicate charges, contract discrepancies.
So the AI isn't in a lab inventing new fertilizer. It is just acting as an ultra-aggressive accountant. $100 million in recovered cash is huge.
It is pure margin recovery.
Yeah.
And the second offensive lever is the massive cash unlock. We talked about that $960 million tied up in working capital.
The unsold inventory.
Right, that money hasn't evaporated. It is physically sitting in warehouses.
Yeah.
Management strongly projects that as the spring planting season forces farmers back into the market, they will unwind that excess inventory.
Ah, and when they do,
They project it will trigger a $300 million to $500 million working capital release in 2026.
so they finally clear out the warehouses, the cash flows back onto the balance sheet, and they use it to pay down debt. That is
Yeah.
a massive structural catalyst.
Definitely.
But everything we've talked about so far, potash logistics, sulfur prices, inventory management, it is all tethered to traditional agricultural commodities, which are notoriously cyclical.
They boom and they bust.
Exactly. But if you read deep into these sources, to find Mosaic's true long-term structural value, you have to look completely beyond agriculture.
You have to look at the waste.
This goes right back to the hook. We talked about those gyp stacks in Florida, the waste disposal mountains costing them a fortune in CapEx. What if that exact waste product is secretly a gold mine?
The Uberaba Rare Earth Project.
Yes. It's a joint venture with a firm called Rainbow Rare Earths down in Brazil.
And the industrial scale of this project is staggering. The plan is to build a dedicated processing facility that will take 2.7 million metric tons of phosphogypsum, which again is just fertilizer byproduct waste, and process it every single year.
That is a lot of waste.
It is. And from that, starting in 2027, they intend to extract 1,900 tons of neodymium and praseodymium oxide.
And DPR.
Yes, along with 600 tons of other heavy rare earth elements.
Wait, hold on. You're telling me a company that digs up fertilizer components out of the mud is going to seamlessly pivot to processing highly advanced rare earth metals used in EV motors?
That's the plan.
I mean, that sounds like a pipe dream designed by a PR team to pump the stock price. How realistic is this extraction technology, actually?
Well, what's fascinating here is that the chemistry is already proven. The phosphogypsum waste already contains these rare earth elements. The challenge historically was extracting it economically.
Right.
But Rainbow Rare Earths has the proprietary separation technology to do it at scale. And this raises an important question. How does the federal government view a fertilizer company that suddenly holds the keys to domestic EV battery supply chains?
I imagine they take it very seriously.
They do. In late 2025, the U.S. government officially added both phosphate and potash to the nation's critical minerals list.
Oh, wow.
Yeah, this elevates Mosaic from a simple agricultural supplier to a protected cornerstone of national security and defense technology.
And it isn't just rare earths either. Looking at the operational updates, Mosaic has also been quietly scaling a biologicals platform.
The Biosciences Division.
Yeah, essentially advanced biosciences for crop yields. They doubled their sales in that division to $68 million in 2025, and the gross margins on those products are in the 40s.
That's huge.
They are incubating high-tech, high-margin businesses inside a legacy mining company. And the kicker is, Wall Street seems to be completely ignoring it.
They really are.
The analysts at the big banks are so hyper-focused on the short-term sulfur squeeze and Q1 EBITDA headwinds that they are pricing the stock solely on the next 3 months of fertilizer demand. This rare earth extraction project, the biologicals growth, is essentially a free option built into the current stock price.
Which brings us to the final verdict on the investment roadmap. If you synthesize the entire board, the short-term financial squeeze, the logistical mode of Canpotex, the tariff protections, and this hidden innovation pipeline, what you have is a classic deep-value cyclical recovery play.
Okay, let's look at the valuation.
Right now, Mosaic is trading at a price-to-book ratio of 0.81.
Just to clarify the metric for you listening, a price-to-book ratio of 0.81 means the market is valuing the entire company at less than the sum of its raw physical parts. You can essentially buy their mines, their rail cars, and their ports for 81 cents on the dollar.
Exactly. And to put that in perspective, the median price-to-book ratio for their sector peers is 2.49.
That is a massive difference.
It is. Mosaic is drastically undervalued compared to the broader market. It stands as a highly strategic inflation play. If you believe that agricultural demand will normalize in the spring, and you see that massive $300 to $500 million cash unlock coming as inventory clears in 2026, there is tremendous high margin upside here.
So what does this all mean? This right here is exactly why we do these deep dives. If you are an investor and you just read the top line headline like, war in Middle East drives fertilizer prices up 25%, you might blindly buy the stock assuming record profit.
And you're in for a rude awakening.
Right. You would get completely blindsided by the billion-dollar working capital drain and the brutal margin squeeze from sulfur costs. You have to understand the granular mechanics, the raw material inflation, the strategic factory pauses in Brazil, the AI auditing.
Absolutely.
And on the flip side, you have to spot the hidden assets like rare earths sitting quietly in their waste piles.
Knowledge in the market is only valuable when you can see the whole board, not just the pieces that are making the most noise.
Well said. Before we wrap up today, I want to leave you with a final thought to ponder. We talked about how the market expects a simple cause and effect. A fertilizer company sells fertilizer, and it is valued as an agricultural commodity.
Right.
But if this Uberaba rare earth extraction process actually proves highly scalable and wildly profitable by the end of the decade, well, could the tail eventually wag the dog? Could we see a day where a company historically known for feeding crops is valued primarily by Wall Street for feeding the global tech and defense industries?
That is a wild thought. It completely rewrites what it means to be an industrial business in the 21st century.
Risk defined, portfolio protected.